In the second quarter of 2020, US corporate profits after taxes stood at $1.8 trillion. Today they stand at $3.6 trillion. This is by far the largest 5-year jump in US corporate profits in recorded history. It took 33 years between 1986 and 2019 to make an equivalent jump in corporate profits. The reality is that corporate America has never had it better than today in 2025. And yet, as this is happening, roughly 50% of retail investors are actually bearish on the US stock market today, according to data from the AAII Investor Sentiment Survey. That means half of individual investors expect the stock market to actually go down over the next 6 months. This is a historically high level of pessimism. Going back to 2012, the average percentage of investors bearish on the US stock market stood at roughly 30%. The pessimism on US stocks today is unmatched. Now, a lot of this pessimism is grounded in reality. We've had multiple stormy clouds looming above the economy in recent months, such as a potential unfolding debt crisis, which could cause interest rates to spike, tariffs, and a trade war that can freeze the economy, leading to a recession, and more recently, a war in the Middle East that could potentially lead to an oil shock. All of these concerns and uncertainties are very much justified, and they've been keeping most retail investors sidelined in recent months, despite one of the most spectacular stock market recoveries that we've seen since 2020. But corporations, on the other hand, have been taking advantage of the stock market volatility to go on one of their biggest stock buying sprees in decades. By the way, there's only a couple of days left to take advantage of the 30% discount that we're doing for the 4th of July. You'll have access to the entire Bravos Research trading strategy, which includes all of the buy and sell alerts that we send to our clients when we see opportunities or risk. You'll find all of our trades on our homepage, both winners and losers. If you're interested, don't miss this chance to get the service at a discount. This chart right here shows us total S&P 500 company buybacks. So this is when corporations are using their cash in order to purchase shares of their own stock in order to regain ownership of their company. And as you can see, we've seen some of the largest buyback announcements in early 2025 since this data set began in 2000. So it looks like corporations are gearing up in anticipation of a surge in their stock's price, taking the complete opposite stance to retail investors. And there's a few key factors that I'm going to show you that could prove corporations right. Firstly, US stock market earnings are inching to new all-time highs as we speak. This chart shows us the expectations for the next year of S&P 500 earnings, and this right here is what they've been doing throughout 2025. So despite all of the concerns on how tariffs could paralyze the global economy and immediately bring out an economic recession, stock market earnings have actually held up very steady and have continued to grow. This is something that we've been calling for and highlighting for the last couple of months now, that there is just no evidence of the stock market's fundamentals deteriorating as a result of tariffs. Now, a lot of this resiliency in earnings can be attributed to the technology sector that has seen its earnings move substantially higher throughout 2025. Considering the technology sector now makes up a large chunk of the broader US stock market, the strength from large cap technology companies has put significant upwards pressure on S&P 500 earnings as a whole, and so pushed the stock market higher. And the truth is, over the long run, S&P 500 returns are in large part driven by the underlying earnings of S&P 500 companies. Earnings are what define the broader uptrends and downtrends in the US stock market, and they are the reason for why the stock market tends to go up over the long run, simply because stock market earnings tend to go up as the economy is steadily growing. Strong growth in corporate earnings have driven the stock market rally throughout 2023 and 2024. And although we've had a little bit of a slowdown since the beginning of this year, we are most definitely not seeing a full-blown contraction in earnings, similar to what you typically see during economic recessions. Our opinion has been that earnings would hold up as the economy actually does avoid a recession, and that seems to be what's playing out. In fact, we think that earnings can begin to accelerate higher again heading into the end of the year, providing a further tailwind to S&P 500 performance. One of the things that can drive this strong performance is actually the US dollar. You see, the chart of the S&P 500 index that you have in front of you is priced in US dollars. This is the S&P 500 index priced in euros. See the difference? In euro terms, the S&P 500 index is still significantly below its all-time high from the beginning of the year, whereas in dollar terms, the S&P 500 is at all-time highs. So the recent rally on US stocks in general has been propelled higher as a result of a weakening US dollar. And we think this is a theme that can actually continue over the coming months. One of Donald Trump's administration's key goals is to restructure global trade and monetary relations in an effort to weaken the US dollar to make American goods, services, and labor more competitive on the global market. Ever since Trump began the trade war in February, the US dollar index has fallen by roughly 10 percentage points. We don't think this is going to be a one-off. There could be counter-trend moves, of course, but we think it's very likely we're going to see a structural decline of the US dollar over the course of Donald Trump's mandate, as that is one of his key goals. And as we just saw, that would mechanically put upwards pressure on the S&P 500 index, but it would also put upwards pressure on the underlying earnings of S&P 500 companies. Half of the S&P 500's revenues currently come from abroad in various different currencies. The companies within the S&P 500 are very much multinational. So as the dollar weakens, the foreign income of these companies will begin to look bigger and make the whole pie grow as a result. As the dollar weakens, you'll see more and more of these multinational companies beat their earnings expectations and sending their shares higher. So we have a record profit margins, record corporate buybacks, record earnings, and also a weakening US dollar that can push stocks higher. And as if all of that wasn't enough, we also have the Federal Reserve, the US central bank, that is cutting interest rates. The Federal Reserve has already cut its federal funds rate from a high of 5.3% to 4.3%. But market expectations are currently anticipating multiple more rate cuts throughout the rest of 2025. Lower interest rates makes borrowing cheaper, which tends to provide a boost to economic growth, and lower interest rates also tend to make investors take on more risk, which pushes stock market valuations higher. So we have a multitude of different factors that are driving the strength on the S&P 500 today, and that could continue to do so in the months ahead. This is exactly what has been driving the spectacular performance on the S&P 500 recently. Now, although we do think the market is overextended right now and is vulnerable in the short term to a 4 or 5% pullback, ultimately we still believe the market has plenty of room to run higher from here heading into the end of the year. Again, if you want to have access to our entire trading strategy, including all of our trades, all of our analysis, make sure not to miss the discount that we're doing for the 4th of July by clicking on the link down below. I look forward to seeing you there. Thank you for watching.